Are you getting robbed with fees on your investments? You might be, and that's why index investing often beats actively managed funds. Index funds buy the whole market at ultra low cost. Active funds try to outsmart it. After fees, taxes, and timing mistakes, most active funds underperform over long horizons. With indexing, you lock in the market return minus a very tiny fee. With active investing, you must outrun higher costs just to break even. Fees look small, but compound brutally. Put $100,000 to work for 30 years at 7%, you get about $760,000. You drop that return by just 1% from fees down to 6%, and you end at nearly $570,000. That's about a $180,000 shortfall. Many index funds charge 0.03 to 0.1%. Many active funds are 0.75 to 1.25%. That fee gap is a silent thief. An index fund holds hundreds to thousands of companies, so no single manager's bad call can sink you. Active funds add manager risk. Styles change, people leave, and hot streaks can cool. Simplicity beats impulse. Indexing reduces decisions, so you're less likely to chase winners or panic sell losers. Fewer decisions equals fewer unforced errors. Index funds trade less and tend to distribute fewer capital gains, letting more growth compound untaxed each year. Active turnover often hands you tax bills that you didn't plan for. You'll always find a few managers who crushed it so far, but persistence is rare after cost. Picking the next winner in advance is mostly luck for most investors. Active can be reasonable if fees are low, taxes are sheltered in an IRA or 401k, and there's a clear evidence-based edge, like a disciplined factor tilt towards certain niches or exposures. Be honest though, is it edge or hope? An example of where this may make sense is if you're looking for a micro cap fund or some type of alternative fund that isn't really offered in index form, then an active managed fund may make more sense. But if you're just picking large stocks trying to beat the market, then you're probably not going to beat the standard index fund and their ultra low fees. So what's the playbook here? You want to build a low-cost index fund and ETF portfolio that gives you exposure to the total world market. You want to automate your contributions, rebalance on a schedule, ignore the headlines, and let time and diversification plus the low fees do the work. Bottom line here, don't get robbed by fees. For most investors, the market average minus near zero costs beat the average active result over time. Keep costs low, stay diversified, and keep buying.